So people say they don't get a straight answer about fees. Investment fees are very misunderstood. So in today's episode, we're going to walk through a practical guide to help you understand the different types of fees that you might be paying when it comes to your advisor and your investments.
This is the Money Master Podcast.
Welcome back to the Money Master Podcast. So Connie here with Nick and Tori, and we are here to talk about advisory fees. Not just advisory fees, but fees. This should be exciting.
They're misunderstood. And
yes,
we are kind of laughing a little bit because people think they don't pay a lot of fees or they really don't understand,
Well, yeah, it's the vague subject. People don't know
Right.
what's out there and what they might not know they're paying, what they could be paying. All
In
of the
some cases,
options
you might
they
not be
have.
paying a lot of fees, and we're going to hopefully help you to understand that today as well. So we're going to talk about, the fact that people, they tell us that they either say, I'm not paying a fee, and they might be right, but most of the time they're not. Or they say, I don't understand the fees that I'm paying. So, hey, we don't mind people getting paid. We just want to know that, how do they get paid, right?
And that it's transparent.
Right. Because it's something we hear on the regular is like, well, I asked them, but I didn't really get a straight answer.
Right. People should know what they're paying.
Right. All right. So we're going to talk about the different types of fees, different types of scenarios where you might be paying a fee. So the purest type is when you have an advisor fee plus the investment cost. Okay. Meaning what I think is probably the purest form is I know what I'm paying my advisor and I know what my investment cost is. And so this is where you have a clearly defined advisor fee. And, that could be anywhere from 0.25% up to a whopping 2%, industry standard being, let's say, 1%. And then on top of that, you have whatever you're paying for your investments, right? And if it's pure stocks, well, then there's nothing that you're paying. If it's funds, well, then there's something that you're paying, right? So that would be the purest type. Now, you also have a combination of fees. So you could have, and bear with me, I'm not trying to confuse you here, but you could have an advisory fee plus mutual funds. So that would be you're paying your higher cost mutual funds, let's say, advisor fee plus stocks and mutual funds. So maybe you own some stocks and you have some mutual funds. You could have an advisor fee plus third-party manager plus stocks or mutual funds or exchange traded funds. Okay. Meaning so you're following me. It's basically the advisory fee plus whatever it is you have.
You're invested
investments.
in. Yeah.
And then you could have an advisory fee plus ETFs and stocks, which would be exchange traded funds and stocks. Now, a disclaimer, I'm not giving any particular advice here for anybody. Now, I personally lean towards the advisor fee plus ETFs and stocks. And there's some other combinations. You could have no advisor, right? So then no advisor fee plus mutual funds. So the cost of the mutual fund. We could have no advisor fee plus exchange traded funds or stocks. We could have no advisor fee plus a 401k, right? You could find yourself in this type of situation. I'm either paying an advisor fee or I'm not. And then I have the cost of my investments. There's a lot of different possible combinations. I showed you the combinations first because now we're going to talk about what are the
Investments. What's inside those investments?
how does that happen in a way that maybe you're not seeing and you're not aware of?
Right.
Okay. Clear as mud so far, right, Connie?
absolutely.
We're just waiting
See
for
right through it.
for her to interject here. So let's talk about, what's inside of these investments. Like,
Mutual funds, ETFs, like what's in them, right?
how does it show up, right?
Mhm.
Because like we said, people think they're not paying a lot in fees and maybe you're not. And maybe you can figure out if you're one of those people. So first what we're going to do is we're going to break down mutual funds and then we're going to break down exchange traded funds, which also known as ETFs, and then 401ks. Like where do these show up? So with mutual funds, which mutual fund is a basket of stocks, and it is usually a mutual fund company that then rebalances these things inside of the fund. And the promotion is, okay, I'm a diversified and I have an investment manager that I don't have to pay directly for, but you're paying in a certain way. We've said in other episodes where we've talked about how it's pretty much straight up fact that 8 out of 10 years, mutual funds and actively traded ones do not beat the more passive exchange traded funds. So that's what we're talking about here is these mutual funds. So where do the fees show up? You have front end loads, you have back end loads, And then you have level loads. And then one more, you have NoLoad funds. Okay.
Lots of loads.
Lots of loads.
Too many jokes.
Yeah. So, what's a front end load? Commissions get paid up front. You pay $100,000 you put $100,000 into an
Into
investment,
the fund, into the mutual fund.
and only $95,000 gets invested because, let's say, $5,000 goes to the advisory firm. Okay. And that would be, that front end load. And then hopefully you don't have to change that, because then there's more loads, right? If you were to want to adjust that, or, hopefully you just own that for a long time because you've paid that commission up front. The second type is that back end load. And that's when the fee is paid when you sell the fund. So there's just a percentage of penalty when you sell. And if you own it for a certain amount of time, then that percentage can go away. Okay. And then the third one is that level load. And I don't know if we've talked about this on our show very much, but 12B1 fees is a marketing fee that happens forever, and it's level. So as long as you own that, you're always paying this marketing fee. It was like a finder's fee for the group that used it. Okay. And this happens inside of mutual funds. And what I want to say about these level loads that's kind of insidious is that they don't show up as dollars.
Yeah, they're not clear. When we talk about transparency, they're not super transparent. You're having to figure out what they look like.
It's a percentage. So like you could say, well, I'm paying this much in an advisory fee, and you could see some prospectus percentages on the other stuff you own or whatever. But if you really wanted to understand how much it's costing you, you'd have to kind of multiply whatever that expense ratio is. And expense ratios can be anywhere from 0.25% all the way up to 1%. So if you had, $100,000 investment account and you had a 0.5% 12B1 fee on it, then $500 a year is not being credited to your return and it's not being quantified in dollars, right? So if you could have got a 5% return over here, well, that means in that fund, maybe you got a 4.5% because you were paying a little bit more of an internal ongoing load.
And that does not show on your statement, correct?
Right. That's what's so,
That's what
irritating about the
people
lack of
don't understand.
transparency.
Yeah.
Right.
Is there a way that someone can figure out how much they're paying on these?
That sounds like a perfect segue to talk about that. Yeah, exactly.
Okay.
So we use a tool that is similar to like a Morningstar tool. And, you could actually go to Yahoo Finance. So you can go to finance.yahoo.com. You can put the fund name in the box, click on profile, and it'll show you if it has a front end load or an expense ratio or a 12B1 fee.
So
Now-
you can't find it, but you have to look for it.
Yes. And sometimes it'll show that it could have a load, but then it also has an ongoing, and you're not sure which one you have. So you have to kind of find that out a little bit further. Okay. So in that case, you might have an advisory fee, plus you're paying an ongoing. It's internal that maybe you're not aware of.
Or you paid to get in, or you're going to pay to get out.
Right. Pay to get in. And then lastly, you have the NoLoad funds. And these don't charge any type of sales load, but the advisor still may get a kickback through the fund itself. So like maybe they have a selling agreement with the organization, so they're getting paid in a way that is paying them from the fund. So you never actually see that either. So my criticism of these no-load funds is, well, there's no load on it, but they're taking the money from somewhere. So they're taking it and are calling it a management fee internal before it actually gets to your bottom line.
Right.
So the bottom line is you're still paying.
Yeah.
You're just not aware of what you're paying.
Hey there, this is a quick break to talk about how you pay yourself in retirement. People often ask about how much they're going to be able to spend each month from their savings when they're no longer working. You may have heard of the 4% rule, the bucket strategy, or nameless others, but none of them do a good job measuring your true spending capacity. That is, how much can you afford to spend each month confidently? I wrote a white paper you might want to read. It's about a guardrail system for retirement that can help you do better in retirement. And I think it's probably the best withdrawal strategy available. There's no cost to download and read it. If you want a copy, all you have to do is text the word income to our business line at 214-988-9178. That's it, just the word income and send it to 214-988-9178, and we'll send that paper about guardrails straight to you.
So is there a reason that these fees are so hidden?
Good question. I don't know. I can tell you that it's been a point of contention for a long time. Um, People are blissfully unaware, and a lot of people who don't care are like, well, as long as it's going up, that's all I care about. The problem is if you look inside of these funds, you'll find the exact same companies that you could own if you had individual stocks, or the next one we're going to talk about, which is exchange traded funds. So you might have Disney stock in a mutual fund, and you may have the same Disney stock in an exchange traded fund. And, it's just a lot cheaper to have it
Well,
inside
and
of the exchange traded
I
fund.
think from a mindset perspective, to some degree, there's a level of like, I'm okay being unaware. Someone's getting paid somewhere, I'm making some money. But then when they come talk to us and we're very transparent with their fees, they're like, oh my gosh, I don't want to pay
Yeah,
1%. That's so much. I'm like, well, let's look at what you're paying and you don't even know.
right,
Like, it's kind of like, I'm just unaware of it. Don't tell me.
right.
But then when you see it played out, you're like, oh,
Right. Or you might think that advisor is more expensive than what you have because you don't realize what you're paying. It's just that maybe they are being more transparent. So if they're charging you that 1%, you're like, oh my gosh, I'm paying 1%. I see these dollars on my invoice. I see these dollars going off to fees. And then the next question is, well, how much are your investments costing you? And how much were they costing you? Because if you had these internal costs, you probably were paying the same and not made aware of it, or maybe you were paying more and you weren't aware of it. It's just that you don't know. So my problem isn't people getting paid. My problem is people not knowing what they're truly paying.
right.
Okay. Which leads me to the next one, which is exchange traded funds. So we just talked about mutual funds. Now let's talk about ETFs. Now, the way that this works is it's similar to a mutual fund in that it is a basket of stocks, but it's more formula driven and less manager driven. It just follows an index, or it rebalances based on a certain discipline. And so therefore they tend to be lower cost. There can be higher cost exchange traded funds, but there can also be lower cost exchange traded funds. And so the way that you pay that you don't see is called an expense ratio. Okay. And that expense ratio is also how other people get paid along the way. So it could be similar to a mutual fund. The difference is you might be able to find lower ones. So like, for example, you could have an exchange traded fund that's 0.06. So like 6 pennies on 100 pennies, cost. Or it could be 0.40, like 40 basis points, or it could be 80 basis points, or it could be 1% or more. Okay, there's several popular funds that people like that have internal expense ratios of above 80 basis points. Okay, so, you know, you could look online at Yahoo Finance and you could find that for yourself. You could have an advisor look at a tool to show you what your total expense ratios are. But the other key here is that that's never spelled out in dollars and cents. So you never see a dollar sign on your statement. So if you have a $100,000 investment and you're only paying 6 pennies, then that's $60 a year in internal cost, right? But if you're paying 50 basis points, well, that's $500 for every $100,000. And what are you getting for that, right? Can we justify that?
This might be a silly question, but there's that phrase, you get what you pay for.
Yeah, that's a
So,
great thing to bring up.
like with these ETFs that are different costs, like is one better than another?
That is such a great thing to say because people actually do think that and say that. They say, well, you get what you pay for, right? I'm
So I'm
paying
going to
more.
pay the more expensive
It
one
must be
because it must be
better.
better. Yeah.
Yeah.
It's going to perform better or whatever.
Read enough investment books and you'll find that if you believe that passive in owning the passive market, okay, is usually greater or equal to money management, you'll find that for the most part, buy and hold passive strategy tends to not do worse and in many cases does better than almost everything else out there. So, why pay that extra, right? And there is a reason, okay? For example, there are a set of funds that we sometimes like to recommend that I would say we hardly ever use them, but they have a higher expense ratio and it's slightly higher. And the reason it's higher is that they pick undervalued small capitalization companies and they rebalance at a time when the world doesn't really know they're rebalancing. So there's no market movement like there are on the big ETFs. So you can actually say, okay, there's a justification for how they're doing it. They're not just taking the entire index, they're taking a certain section of an index. And so then maybe that justifies a little bit higher cost, and you can prove that out. But then on the flip side, there could be somebody, in fact, we're going to talk about it in a second when we talk about 401ks. They could be wrapping something in a popular package to make it sound brand name, but
And charge more.
there's no benefit, right? It's like when you got imagine a good pair of jeans, that just good quality jeans that cost $30, but then there's another good quality pair of jeans that cost $150 because it has a different label on it,
Right.
you know?
Yep.
So that's exchange traded funds, right? Now the third one is going to be 401ks, right? So we've talked about mutual funds, we talked about ETFs, now we're going to talk about 401ks. People love to think that they're not paying anything for their 401ks. They like to think that they're low cost. And I have to tell you, it is a rare, rare day when I see a low cost 401k. And a lot of it is because they're not super transparent. Okay. We set up a 401k for ourselves at Brindle Bay, and we worked really hard to get low cost exchange traded funds in there. But there were so many companies making the same types of funds that they would offer in other places, but they would use a different ticker symbol because it was offered inside of a 401k. Why? Because some organization wanted to get paid along the way. Okay. So where those fees show up is in a term we term it fund of funds. Okay. And that's when you you take funds and you make another fund of it. You say, okay, there's all these name brands in this fund. And that's what happens. It's a fund of a fund. So especially on your statement, it might say, well, you're in the growth fund or you're in the growth and income fund, but it doesn't really show you exactly the names of the companies. It might say you got so much large cap, so much small cap, so much mid cap, so much value, but you're not actually seeing the real names. That's where you know you're paying more and you're just not aware of it.
Yeah. We love when we get those statements and you're like, yeah, we can't tell what ticker symbols you're in, right? You're in the growth fund.
Right.
And people have no idea what they're in.
Right. And one of the ways that this hides is instead of it being an expense ratio, which it can be kind of referred to as, there's something called the net asset value. Okay. And that's where the waters get muddy because funds of funds invest in other mutual funds. And they can all have their own fees and their own managers and their own sets of fees. And it's not always clear, how much of a ratio are you really paying? Okay. So here's what happens. You have Disney stock that you could have own individually. You could have in an exchange traded fund. Probably not great to be using Disney as an example because I'm not, a fan of how they've been acting lately in the last couple of years, but I'm just using it as an example. And then you could have that same Disney fund inside of a mutual fund or an exchange traded fund, or it can be inside of a fund in a 401k. But if you're paying all kinds of layers fees on top of that, you're just paying, a lot more money for that. So you might go, well, I just care that it goes up. Great. But you're also not getting as much of a return. Does that mean that 401ks are bad?
No.
Because we use them for other reasons, right? We use them to be able to defer more money.
Right. It's the one place you can defer a bit more money than just your IRA or your Roth.
Yeah. We use them to get free money from the employer.
A match.
It's an auto savings.
Yeah. There's
way I think about
benefits to it.
Yeah. So you think you're not paying a lot for your 401k, but 401ks also have custodial fees, 12B1 fees, administrative fees, and more. Okay. So I told you at the beginning of this episode to be surprised a little bit, in terms of where your fees are being paid from. You'd be surprised to know that we have a 401k that we use, but it's for the same reasons that I said. It's for us personally to be able to put more money away that we would normally put away. The Roth 401k is a place that you can put more money into a Roth that you can anywhere else, right? And high income earners can also do that. So there is a purpose for it. It's just like any financial tool. We just have to be aware, and I'm not very happy about the fact that I have limited options in my 401k. I can't do the type of management that I would really like to do. And there's not a lot of transparency. But that's just because that's the IRS rules on that particular type of account. So
as a consumer, or someone who's shopping, what questions should I be asking about fees?
what's funny is if you ask these questions with this type of information, like many people don't answer it in such a structured way. So it's difficult to know, except for today, if you were to say, okay, I understand how mutual funds have fees. I understand how ETFs have fees. I think you probably would say, well, I'd like to have ETFs over mutual funds. And I'd like to maybe have stocks over ETFs or a combination, because stocks do not have expense ratios. because they're just the stock. You own the company itself directly. So that's cool. But the reason you use ETFs is that there's some tax advantages to having them rebalance internally. Okay. And more ETFs could be used less because technology is making it so that maybe you could own a lot of companies and still rebalance them properly. But ETFs are, a good middle ground. Okay.
So if I'm shopping for an advisor, someone to assist me in building a financial plan, I didn't know if there was like a specific question or set of questions.
I think fee only or fee based would be nice to ask. Do you use individual stocks in ETFs or do you use mutual funds? I think something practical is if you have 5 ticker symbols, it's more expensive than if you have 1 to 3 ticker symbols. Now, it's not always true. Individual stocks can have 4, but for the most part, like 5 ticker symbols means you're a little bit more involved in terms of cost. But then that leads us to a conversation around the types of advisors. Okay.
Okay. So teach us about the types of advisors.
Okay, so different types of advisors that we've got at play. You've got fee only, fee based, and then you've got brokers. So different, not only are you looking at the investments that they might be
Right.
putting you in, you're looking at how they're getting paid.
Okay.
So we're going to talk in generalities, right? Because, there's always an exception to the rule, but fee only advisors, in my opinion, they're never going to offer mutual funds that pay them a commission. Okay. And the reason is they're fiduciaries and there's a transparency and a best interest. Now, that's not, if they do offer you one, they're going to be transparent. They're going to tell you how much you paid.
The commission is not considered a fee. Like for a fee only
Correct.
dialogue.
Right. So for the most part, it's actually kind of against the rules. You can't say you're a fee only advisor and then accept commission. So I really doubt that they're going to offer commissionable. They're also never going to sell life insurance or annuities unless they're a fee-based annuity. Okay. And they're also, the way that they get paid is really that advisory fee plus an expense ratio. So you could say, okay, this is my advisory fee cost. And then what's my expense ratio? So if you have $1 million and the expense ratio is 50 basis points, okay, well, you know that you're paying $5,000 a year in internal cost that you're not seeing. If your internal expense ratio is 10 basis points, cool. Paying $1,000 extra per year internal that I didn't know, that I don't see. Okay. So that's fee only.
Yep. Then we've got fee based, which then looks a little different. Then you start talking about the commissions and stuff.
Because it could be there.
Mm-hmm.
Right. So fee-based can be advisory fee plus expense ratio, but they also might offer funds that can pay them. So you want to be aware of that. I feel like it's a little bit of a gray area because I'm going to tell you what fee-based advisors are like. And I'll tell you that our firm is we would call ourselves fee-based. We've thought about going fee only, but we didn't feel like it was in the best interest of our clients. And I'll tell you why. But fee-based means that when it comes to stocks, you're kind of like fee only. You only deal in stocks and exchange
ETFs,
traded
yeah.
funds and there's going to be a level of, if we get paid a commission, we're going to explain that. But for the most part, let's say they're not. But then they can also sell life insurance and annuities that may pay commissions. Okay. And that could be bad and it could also not be bad, right? It can be bad if they're constantly trying to sell things that create commissions and maybe create a business model that they don't want to answer the telephone and
Right.
take care of you.
Right.
Um,
Basically, the litmus test there is your advisor willing to disclose what the commissions are being paid? Are they being transparent about even that?
Right. So here, if we were to actually make a commission, we would disclose that. I have to tell you that full disclosure, I don't think, so it's 2024. I don't think we made a single commission this year. I don't think we actually did any of that type of business. And last year, I think maybe we did it once. And that's because we had somebody last week that absolutely is risk averse to the T, and she needs a different type of plan. So we didn't want to say, well, go down the road to the next person.
Right.
Right. And we could do that. Like if we did that, then we could be fee only. Right. So you have to kind of judge, is that fee-based advisor, are they just trying to really do a lot of commissions, or are they actually acting kind of like a fee-only advisor? Okay. And then last, you got broker advisors, and that's pretty much everybody else. Right. And that's your broker advisor who is, representing mutual funds, life insurance, variable annuities. It's confusing because they could represent themselves as people who are doing holistic planning. But if you look at their public record, which would be like their ADV, and see like where do they get paid and how much they get paid, there's actually somebody near us, close to us here in Texas. Their website says they're fee only, And what's really hard for me to understand is that when you look at their public record of where their assets are, they have a very small amount of money that's fee based. It means they get most of their stuff from variable annuities somehow. And so you have to just really kind of ask those tough questions. How are you paid? And helping understand, what all this is, because it's just not a consumer easy profession, right?
No, for sure.
I heard you give an analogy on another podcast about the difference between a broker and a fee-based or fiduciary. Yes.
Yeah.
Okay. Thank you. And I thought it was so great. A broker will sell you
A
a
suit.
suit,
Yeah.
right? Great. Sounds good. But a fiduciary will tailor that suit to
Make-
fit you to
yeah.
a T.
Make sure it looks good.
Yeah.
Make sure it looks good. Yes.
You said it
That
better
was
than me.
great analogy.
Exactly. So brokers are not fiduciaries. In fact, you could always ask, will you put in writing that you're being a fiduciary? And that's the litmus test. Will you put in writing that you are a fiduciary to me? Because if they're a broker, they cannot and won't really put that.
Yep.
Well, thank you for joining us today. This was very insightful. I learned something today. I hope you did as well. Hope that Nick and Tori mostly brought some clarity around fees. And if you would like to speak with our team and build a financial plan, or you have questions around your financial plan, feel free to reach out to us at brindleandbay.com. And remember to leave a comment, like, subscribe, and share with a friend. Thanks.
Nick Davis is an investment advisor representative of Brindle Bay Financial Advisors, a registered investment advisor. This show is for informational purposes only. Any references to client experiences made may be deemed to be indirect testimonials. Clients were not compensated for providing any testimonial statements. Any references to client experiences are for illustrative purposes only. Actual client experiences will vary. Any exposure to ideas and financial vehicles discussed should not be considered financial advice or recommendation to buy or sell a financial vehicle. You should consult a qualified financial tax or legal professional before taking any action. This program is not endorsed by the Social Security Administration or any other government agency. Brindle Bay Wealth Management is affiliated with Brindle Bay Financial Advisors.